Hi everyone, I'm Ali, and in this video we'll talk about corporate governance structures. Corporate governance comprises the rules, systems and processes within companies used to guide and control activities. Governance structures help to monitor the actions of staff and assess the level of risk faced and properly design controls to reduce identified risks and ensure the future viability of the company. In Australia, the ASX Corporate Governance Council published its Principles of Good Corporate Governance and Best Practice Recommendations in 2003 and updated them in 2007, 2010, 2014 and in 2019, which is the 4th edition. It's not expected that all listed companies will follow these guidelines. Instead, the ASX suggests that all companies consider the recommendations as a means or method to improve corporate governance structures, improve performance, and enhance accountability to shareholders and other interested parties. The ASX has adopted an "if not, why not" approach to its recommendations, where listed companies are required to disclose whether they have complied with the principles and recommendations. If they have not complied, they must explain why not. When gaining an understanding of a listed client, an auditor will consider their client's compliance with the ASX's corporate governance principles and recommendations and the client's reason for non-compliance where applicable. A client who does not take its corporate governance obligations seriously may not take its obligations to prepare a financial report that provides a true and fair view seriously as well. This slide lists the principles and recommendations of ASX corporate governance principles. As I already said, these principles and recommendations apply to companies listed on the ASX. When gaining an understanding of a listed client, the auditor considers their client's compliance with these ASX's corporate governance principles and recommendations, and the client's reason for non-compliance where applicable. An auditor is most concerned with Principles 4 and 7. Principle 4 is about safeguarding the integrity of corporate reports, and 7 is about recognizing and managing risk. It's important that a client complies with all principles and recommendations as appropriate. And in the next video, we'll talk about the information technology risks. Thank you.